we have a number of active investors who I'm sure are looking at all of this and are making heads of tails of things right now and making some strategic decisions. Just from an investor perspective, could you describe maybe the different tax benefits for 2026 versus 2027 investments? I think there is a lot of misinformation in the marketplace about this topic in particular.
The Opportunity Zone program, the structure of it has not changed. And the investor incentives are the same in the sense that there remain three benefits. They operate differently under 1.0 and 2.0, but there's three benefits at the investor level to investing in an Opportunity Zone fund. So benefit one is a deferral. Benefit two is a step up in the gains that you rolled into the qualified opportunity fund. And then benefit number three is once you meet your 10-year hold period, all those gains are wiped out.
Welcome, everyone. Thanks so much for being here today. I really appreciate your time. This is going to be a very exciting session. And I know many of you have been eagerly awaiting our guest today because of the level of expertise that he brings to this conversation, particularly around opportunity zones and this transitional period that we find ourselves in. So again, thank you for being here. We're very excited to bring Colin Walsh to the webinar today. Colin works as one of the top folks over at Baker Tilly. And just for those of you who maybe don't know, they did over $5 billion in global revenue last year, 43,000 professionals across 141 countries. They've been recognized as one of the world's best companies again last year, by the way. So congrats for that. And very high level for tax, audit, advisory, opportunity zone consulting, everything that we're excited about. Colin, thank you for being here. Really appreciate your time today.
I don't know if I'd say exciting. We'll hope it's educational, informative. I don't know about fun. It is tax law after all.
So maybe just to set the stage a little bit, I mentioned some high level stats from Baker Tilly's website, but tell us just briefly about yourself and how you ended up at Baker Tilly.
As an undergraduate, I was a finance major with a business background. So when I went to law school, I was naturally drawn to a lot of my tax courses. I went to Marquette University in Milwaukee, Wisconsin, and Heritage Baker Tilly firm started in Wisconsin as a large employer in the community. So I think I'm the last millennial in the world who's only had one job. I started at Baker Tilly as an intern in 2008, and I'm still here heading into 2026 if they keep me around.
Yeah, that's exciting. That's actually quite a bit to say. And we all know millennials who fit the other bill. So just very high level, I mentioned Baker Tilly and doing tax and advisory. Did I hit all the big buttons there, or what would you like people to know about the firm before we start doing a deeper dive on OZ 2.0?
The only two things I would mention is Baker Tilly actually this last June merged with Moss Adams, which is another large public accounting firm. So we're now very much a coast to coast organization. We were the 10th largest and they were the 11th largest. 10 plus 11 equals 6 is what we say. We're the 6th largest now. We remain very much a mid-market player. So our client base is more mid-market business as to large businesses.
Yeah, that's great. And Baker Tilly was an early adopter. We'll transition over here into opportunity zones. And now is what I would consider to be one of the leading national tax firms in the opportunity zone space. How are you currently working with, let's say, family offices or high net worth investors to help them become more involved in OZs? How does that play out?
So I would say that our family offices tend to work on a spectrum. My colleague often says, if you've seen one family office, then you've seen one family office, which is a funny way of saying that family offices operate very differently. On the one extreme, we have our family officers that are probably more what I would think of as like a principal protector. They're more interested in preserving wealth, investing in the market. On the other extreme, we have some family offices that function a little bit closer to what you might imagine from private equity, where they're investing in portfolio companies and maybe not getting involved in day-to-day operations, but significant financial investment, in which case, to the extent they have eligible capital gains and their portcos are either in an opportunity zone or could be relocated to an opportunity zone, or particularly if they're in real estate, that portion of our family office clientele is very interested in an opportunity zone. And then there's a lot of stuff, of course, like everything else, that's somewhere in between, where we're not wealth preservation, but we're not a private equity outfit, but we do invest in portcos and such. I think it's an exciting time. A lot of investors who perhaps during OZ 1.0 were maybe sitting on the sidelines as there was a general lack of clarity on proposed regulations and more proposed regulations and final regulations and administrative guidance. OZ 2.0 the fundamentals really remain the same from OZ 1.0. So I think it's an exciting time. We're not learning what a QAF and a QSB is for the first time. We already know what those things are. I think the appetite is going to be larger here as we enter 2026.
I know there's been this disparity if you were to interview all these family office professionals or principals, that there's been this ideology that we should be doing that, but we are not. And there seems to be this gap between kind of an awareness of or an appetite for and then true participation in. Are you guys seeing that's uptrending or a difference, or what's the future like there?
I think that early in the Opportunity Zone program, there was a little bit of a reticence because of the unfamiliarity with it. And so people who didn't want to be early adopters, by the time that the OZ became more mainstream, maybe 2020, 2021, 2022, well, a lot of the zones that were established in 2018, there hasn't been any new deal flow since then. By the time people were getting comfortable that the law was settled enough to invest, some of the best deals were gone. So I think having the program now be a permanent part of the Internal Revenue Code, as well as having the law be more established, or at least a framework of the law. And then you couple that with new deals that are coming in through new zones, which I know we'll talk about. That makes it this perfect storm of things that are coming together. And I anticipate next year, there'll be a lot of family offices that are very interested in OZ investments.
Yeah, I don't think you're alone in that. So let's move over. The frame for today's conversation really had to do with the idea of this transition from what everyone's calling 1.0 into 2.0. And so let's move into the updates themselves. There's new legislation, there's new timing of the changes. Can you describe when the new zones are effective and when the old zones sunset?
Yes. So the new zones, to answer your question directly, will be effective on January 1st of 2027. We will learn what those zones are next July. So July of 2026. What that means is that right now, real estate developers and high net worth individuals are working with their state governments to lobby to get zones included in OZ 2.0. We see some clients are doing that. We'll have the new zones. The 1.0 zones will not expire until December 31st of 2028. OZ 2.0 becomes effective 1/1/2027. OZ 1.0 expires 12/31/2028. So what that means is that for the 2027 and 2028 calendar years, both zones, OZ 1.0 and OZ 2.0, will be effective. I would expect that as we get closer to the end of 2028 or 2027, 2028, the IRS will probably want to clarify what you would need to do in advance of 12/31/2028 in order to be grandfathered in. You just have to buy the property. You have to be placed in service. You have to start construction. I have my own thoughts on that, but that's a ways away from now. But as we, start to acquire OZ 1.0 zones, 2027, 2028, I think that'll become relevant.
Yeah. And it's interesting because we also have a map if anybody wants to use it on OZ listings. Currently, all of the GIS survey data for 1.0 is on there. As soon as we have concrete data, we'll create the overlap and then we'll expire it correctly. So if anybody wants to use that, feel free to use that tool. It's helpful to always be able to see what's going on there. I know a number of folks who are lobbying aggressively to get projects placed, and I think that's important. It's always through the governor's office, if anyone's wondering. How does the census criteria for these new zones differ from the census criteria that we were seeing applied for the old zones back when this was first ideated?
In a sentence, the census criteria is a little bit tighter, a little bit more restrictive, not terribly back with the Tax Cuts and Jobs Act under OZ 1.0. We were really using 2010 census data to look at a number of criteria, one of which would be median family income in a given census tract. So under OZ 1.0, for example, the standard was for eligibility to be designated in 80% of median family income in your state. So if a census was below 80%, you were eligible to be a designated opportunity zone. Under OZ 2.0, which would use the 2020 census data, that 80% median family income has been lowered to 70% of median family income. So it's a little bit more restrictive. And then, of course, using more recent census data. 2010 was an interesting census to use because you're using 2010 census in 2018. And if you remember what things were like in 2010, and certainly I do as someone who was entering the job market in that point, things were dramatically different in 2018 than how they were in 2010.
Yeah,
And I think 2020 is going to be a little bit closer to how things are today. Some of those accidental opportunity zones that we saw in 2018 were probably a byproduct of that significant time gap between when the census was taken versus when we were picking the zones.
absolutely. That makes a lot of sense. Let's transition just briefly. We have a number of active investors who I'm sure are looking at all of this and are making heads of tails of things right now and making some strategic decisions. Just from an investor perspective, I would say, could you describe maybe the different tax benefits for 2026 versus 2027 investments? I think there is a lot of misinformation in the marketplace about this topic in particular.
Sure. And it's even more confusing because we had bills that had different rules than the final One Big Beautiful Bill Act. As I said, the Opportunity Zone program, the skeleton or the structure of it has not changed. And the investor incentives are the same in the sense that there remain three benefits. They operate differently under 1.0 and 2.0, but there's three benefits at the investor level to investing in an Opportunity Zone fund. So benefit one is a deferral. Benefit two is a step up in the gains that you rolled into the qualified opportunity fund. And then benefit number three is once you meet your 10-year hold period, all those gains are wiped out. Under OZ 1.0, the rule was that whenever you invested, whether it was when the program was created, so you invest back in 2018, or if you invest today, those gains were going to be deferred until December 31st, 2026. Stale date. That's the deferral date. Under OZ 2.0, we are not deferring our gains into a stale date, but beginning on 1/1/2020, when the new investor level rules kick in, there's an automatic 5-year deferral. So if you invest in 2027, they're deferred until 2032. If you invest in 2028, your capital gains are deferred until 2033. The step-up rules, the second benefit, also functions a bit differently. So under OZ 1.0, there was this concept that if you invested in an OZ fund for at least 5 years or 7 years prior to 12/31/26, which meant you had to invest to get 5 years, you had to invest before 12/31/21, you would get a 10% step up. So you deferred until 12/31/26, and then 10% of the capital gains you rolled into the QUAF would be exempt from tax. The other 90% would be taxable. If you were at 7 years, it'd be a 15% step up, not a 10. Well, under OZ 2.0, we don't have a 10 and a 15% step up to a stale date. We defer for 5 years, and then the step up is either 10% or 30%. And I know we're going to talk about the rural zones in a bit, so I'll hold off. So you get a 5-year deferral, and then if you make it to year 5, you get either a 10 or a 30% step up. So that's also different under OZ 2.0. And then the big kahuna, the main benefit, the main reason to do this program, at least in my client's experiences, is not the deferral or the step up, but rather the 10-year rule, which says if you hold your equity in a qualified opportunity fund for a period of 10 years, after year 10, when you sell, any capital gains are tax-free. And that's the same 1.0, same 2.0. So just in sum, the difference of investing in 2026 versus investing in 2027 would be if you invest during 2026, you're only deferring until 12/31/2026. You invest on January 1st of 2027, you're deferring for 5 years and getting a 10 or a 30% step up.
This is an easy question, so I'm going to give you a softball, but I've heard it said incorrectly on multiple public forums now. So if somebody realizes a gain on December 31st, 26, and they then place that into a QUAF in 27 within their 180-day window, what plan are we in?
It's the date of the investment, not the date that the capital gain is realized. So you would be playing under your example, if you're using a 180-day investment period, if you realize a capital gain, you sell Apple stock in the second half of 2026. From a tax perspective, and I understand that business needs sometimes dictate otherwise, but from a tax perspective, if you can hold off and roll your gains into the QUAF in 2027, you're going to get a much better tax answer. Something else we think about a lot are the K1 rules. So we already have clients, just to reiterate some rules, if for directly held capital assets like Apple stock, if a taxpayer owns Apple stock, you sell that and you got to invest within 180 days when you sell it. But to the extent that your capital gains are received via Schedule K1 because you're a partner in a partnership or a shareholder in an S corporation. In those instances, you can pick one of three dates to invest to start your 180-day window. It's either the date that the pass-through entity sold the capital asset, the final day of the pass-through entity's year, or the unextended due date of the pass-through entity's income tax return. I'm going to reiterate, unextended due date, not the date that they filed the return. So we already have some clients where if business considerations allow for it, to the extent that they can hold that capital asset and sell it in early 2026, well, if it's K1 gain, which in real estate, a lot of stuff is K1 gains, they can comfortably get into a 2027 investment and take advantage of the expanded deferral and step up.
Yeah, it's smart. And I assume that a lot of your, especially more sophisticated investors, are being hyper strategic right now with this awareness of how things are shifting and moving, and particularly with the help of the professionals in your team. Are there other strategies that you're seeing that folks are using that are important to note?
Installment sales. So to the extent that not just strictly for the tax answer, but if there's a legitimate business need for an installment sale and any kind of exit, each installment it's going to create its own 180-day investment window. So if you can kick gains into 2026 and beyond, that's a different strategy to do it. Something else to think about. I've had a client who, from a business perspective, needs to sell in 2025, which means they cannot invest in 2027, but they can roll their eligible gains into a QOF during 2026. And then that QOF can invest in a QSB that presumably acquires property under OZ 2.0. So they're not going to be able to take advantage of the deferral and the step up, but they are strategically selling and investing in a way that enables them to at least see what the menu looks like, so to speak, under the OZ 2.0 zone. If you're smart about when you put that money into the fund in the second half of 2026, you can then push it down to your QSB and acquire property under some of the OZ 2.0 zones.
Smart. Yeah, that's terrific. And you had mentioned earlier, let's go this route because it's gotten a lot of attention with the big, beautiful bill and so forth. Speaking about rural and some of the specialized incentives, there's been a ton of attention now on the rural designations, and we will be integrating those into our map as everything gets finalized. But maybe describe the extra incentives, but then also, are there any other criteria and how are you predicting that's going to be utilized? Is it going to trend? That is also maybe a good follow on.
Well, when you mentioned lobbying earlier for that 30% step up, we certainly have some clients in Wisconsin right now, and we've got some areas that are interesting for development that would constitute rural under the Big Beautiful Bill Act. So a lot of people are hoping to get their tracks in there. But yeah, there's really two principal benefits, I would say. There's an investor benefit and then a developer or a business operator benefit. So as I mentioned, there's a 5-year deferral in either a 10 or a 30% step up. If you have a qualified rural opportunity fund, a CROF, got to have acronyms for everything in tax, then your step up at year 5, if it's a rural investment defined as a population of under 50,000 people, your step up is 30%, not 10%. So that's the investor benefit. The other rural benefit is more on the either real estate developer or business operator side, which says that in order for OZ fund or a QOZB to hold, we'll call it good asset. When we say good asset, we mean qualified opportunity zone business property, QOZBP. Under OZ 1.0, make a building into a good asset. We had to double our cost basis in that building. So you buy a building for $1 million, you got to put more than $1 million into the building to make it a good asset, which makes sense because the legislative purpose of the Opportunity Zone program is to make disenfranchised communities nicer. So they had to pick some standard, and the standard was double your cost basis. Under OZ 2.0, the double cost basis standard still exists unless you're in a rural opportunity zone. In that case, you don't have to double your cost basis. You just have to improve it by 50%. So in my example, rather than needing to put $1,001 in, you only have to put $500,000 in the building to make it a good asset. A couple of breaks for rural zones there.
Yeah, that's huge. I know a lot of the folks with whom I've been speaking believe that we're going to see a lot more deal flow in rural as a result, both because of the investor benefit, but also the benefit to the developer, which is really exciting. May also play out in the business side of things. If we see a lot of incubators popped up during 1.0, I think we'll see some of that happen, but it might be moving into some of the kind of more rural or college town kind of communities that can qualify with this. So that'll be exciting. And then I had a note here to ask you about IRS Notice 2025-50 and what that stated about the rural zones.
Did a couple things. So IRS Notice 2025-50, one, clarified the definition of a rural zone, and I won't get into the weeds on that. But perhaps more exciting, it established, and there's a literal list, you can Google it and pull it up, in IRS Notice 2025-50. I'm just saying it again in case anyone wants to write it down. You can see what census tracts under OZ 1.0 qualify as rural opportunity zones. And to the extent that you have a rural opportunity zone under OZ 1.0, the notice goes further to say that 50% double your cost basis standard applies already, that it was effective. So we tend to think a lot of the OZ 2.0 laws as taking effect on 1/1/2027, but according to the notice, not so for the definition of a rural zone, that immediately, to the extent you wanted to do development in a rural zone, you'd have that 50% double your cost basis standard.
Yeah, which is such an exciting part of the new rules. So I'm so thrilled to see it play out. So we have a question, and sometimes I save them to the end, but this is great, and I want to make sure we don't miss out. Paul, one of our guests, asked, could we explain the means and methods by which capital gains can be harvested tax-free after the 10-year hold?
The means and methods that they can be harvested.
Are there restrictions on how you can exit an opportunity zone?
So there was some confusion under and this kind of gets into what we talked about earlier about why there was not a lot of deal flow. So the way that the first set of OZ regs was written, they were written in a way that suggested that the only way to take advantage of the gain exemption was to sell your equity in the qualified opportunity fund. So this is a lot of real estate deals where we have this two-tier structure of you got a QOF with a QSB underneath it, and the QSB holds the real estate. And so some of the feedback from the practitioner community was, boy, if people have to sell their equity in their QOF, most real estate is going to be an asset deal. People want to buy the property, not partnership interest. So I think back then there was some confusion, but in the final regs, it was clarified that you can sell asset deal, you can sell stock deal, and that either way, your capital gains are going to be wiped out.
That's terrific. I think we covered rural and some of the special incentives that are there. Finally, let's touch on a few more advanced and forward-looking compliance and structuring consideration, maybe around why valuations might be required next year for investments made under OZ 1.0.
Yeah. Well, it's year-end planning season at public accounting firms. So we sit in front of our clients and talk to them about what to do for 2026. And so for all of our clients that invested under OZ 1.0, which is a lot of them, we have to remind them this time of year that the tax bill is coming for the gains you deferred into a qualified opportunity fund. And so for a lot of them, one strategy that we're looking at is what the Internal Revenue Code says is that you are required to pay the lesser of, important word being lesser of, the capital gains you rolled into the qualified opportunity fund, or the fair market value on December 31st, 2026 of your equity in the qualified opportunity fund. So if you invested $1 million into a qualified opportunity fund in California in 2023, and because of elevated costs and interest rates and everything else that's going on in that community or certain subsets of the community, or maybe you were going to invest in a commercial space and you can't get a tenant in because commercial real estate's not doing well, whatever it is, it's perfectly possible that your equity in your qualified opportunity fund is worth less than $1 million. That's not to say that it won't be worth more than $1 million 10 years from now, but if it's worth less than $1 million, the amount of tax you have to pay in 2026 is going to tie to the fair market value of your equity, not to the amount of gains you rolled in. The reason evaluation is important is that obviously this is something that could be ripe for abuse. To the extent that you were going to say to the IRS, hey, I invested $1 million of QOF equity, but I'm only going to pick up $600,000 in capital gains. It's worth less. I don't know that evaluation is required per se to sign the tax return, but the IRS were to audit you, they'd say, come on, you got to prove to me, why was it 600? Why not
Sure.
700? Why not 500? So I think valuations are important for that reason. Given the right fact pattern, because of how the real estate market, especially the commercial real estate market, has done over the last few years, we're talking to our clients about that.
Right. I think that's important. And especially since I know that there's a ratcheting up in 2.0 on some of the, let's call them penalties and or scrutiny guidelines. I think it's going to be exciting to see how that all plays out. Everyone should contact Baker Tilly. Make sure you're keeping your head.
Get a credible valuation for sure.
Yeah.
Absolutely.
Yeah.
If we're going to employ that strategy. And I think the question becomes, does the fund orchestrate that? Do the investors? Technically, it's whatever the value is of the quaff owners, the investor in the quaff. But certainly you'd want to talk to the fund, because I'm not sure that it makes sense for each investor in the fund to be getting their own valuations of the same entity.
Certainly not. Let's also discuss then briefly the ability to combine OZ incentives with other types of tax incentives. I know this is where, especially a firm like yours, can really start to make a pretty profound difference for clients. So, what are you seeing there, or what do you believe is going to be next?
Yeah, it's another thing that I'm really excited about, that this program has been made permanent under OZ 1.0. I think our heads were all spinning with acronyms and proposed regulations. So there wasn't a lot of time. We were just trying to digest and understand how the OZ program would work. And so candidly, I don't think much attention was paid back in 2018, 19, 20 to, hey, what other tax and other state type of incentives or federal incentives work well or are compatible with the OZ program? So we've been thinking about things like EB-5 loans. We think about things like low-income housing credits, new market tax credits. There are a lot of federal and state programs, I've just named a few, that are perfectly compatible with opportunity zones that can be part of the same capital stack. So as we move forward, I think now that there's more certainty surrounding OZ and how those things should be structured, and the timing restraints on cash and how we spend cash and what that all looks like, starting to think about blending some of these other programs in with OZ as part of the same capital stack is particularly interesting. You mentioned incubators and venture capital. Another strategy that we saw, and I hope to see more of, is blending together Section 1400Z2, which is opportunity zones, with Section 1202, which is qualified small business stock. Both programs were amplified via the Big Beautiful Bill Act. And they're similar in that both have a gain exemption, but without getting into the weeds, QSBS, qualified small business stock, that is a 5-year hold period, not a 10-year hold period. So I think one of the main reasons why we've seen a lot of capital for OZ go to real estate as opposed to operating businesses is that when you're investing in a startup company or venture capital, you're really not looking for an 11-year hold period. Those investments are an eye toward 3, 5, 7 years, which is why they use QSBS. But there's no reason we can't combine the two and use both OZ and QSBS in conjunction with one another. I promise I won't put people to sleep with a dense discussion of all the different stuff that can work together. But I think being a little bit more thoughtful about, hey, client, you come to me to talk about opportunity zones, and I hear you, but what you really want is capital.
Right.
And yes, opportunity zones are part of the discussion, but think about these other things as well.
I love it. I think it's always exciting to hear someone at your level speak through this, because I know you're gearing down to make sure you don't absolutely obliterate everybody on the call, which is terrific. But I always feel like it's like when I watch Neil deGrasse Tyson talk about physics or something, I'm like, I get it. I think I get it. This is why we use strong professionals. So that's great. No one has a crystal ball, but do you foresee that we're going to see more of the kind of, let's call it, hold back states willing to jump on board with opportunity zones now that they're permanent and we're moving forward in this new reality, or will that friction remain? I'm curious.
I think many would like to the extent that states don't. When states decouple from things like opportunity zones or 1202, it's usually because they can't afford it.
Sure.
It's more of a budget reconciliation thing. I think across the board, I'm part of the Wisconsin Bar Association, so we have these discussions with state legislatures all the time.
I'm sure.
Generally, it's more a function of cost. I think there's statewide support. I know Wisconsin had enhanced benefits for its opportunity zone program, so they doubled on the gain exemptions if you invested in Wisconsin OZs. And again, maybe now that it's become more mainstream and states are more familiar with the structure and how things will work, I could see more states getting on board, but I try not to be in the business of predicting what federal and state legislatures will do because it's very unpredictable.
Sure.
But I
Yeah.
think that appetite would be there.
I could see that. It seems reasonable. So
Okay.
Elliot asked, can the valuation of the QOZ interest on December 31st of 26 take into account discounts for lack of marketability, lack of control, and lack of liquidity?
I love that question. I almost went there. I would predict there will be some administrative guidance written on that issue. As it stands right now, there's nothing in the law that says you can't take those types of discounts. I'm not sure that's something that the IRS would agree with, but it says fair market value on that date. So to the extent that you have marketability and minority interest discounts, the types of discounts we see in gift and estate tax, I think the
Yeah.
valuation teams are looking at that. I'm optimistic that there'll be some guidance from the IRS on that. Something that we've actually done on this very issue is we've reached out to the chief counsel attorneys at the IRS to take their pulse on discounts. Unfortunately, if you watch the news, you know that the IRS is furloughed and not working right now. So we're trying to get some informal guidance on the discount issue, but industry wide, people are aware of that. And I'm hoping to get more certainty between now and 12/31/26.
Yeah. Great answer.
I think
And a
as the
great
law
question.
stands right now, you could take that position. I don't think the IRS is going to agree with it. So it's a function of risk tolerance.
The next question here, they were asking specifically, and not really as a question, but just historic tax credits. Do you see a synergy there and the way that can or could align with opportunity zones?
I do. The preamble to the final opportunity zone regulations was pretty explicit that there's nothing in the opportunity zone program that would preclude, given the right back pattern. And sometimes you're threading a needle to make two programs work together. I'm not a historic tax credit guy, but I do know of clients who use that strategy. So there's nothing in OZ that stops you from doing that. There's nothing that stops a QSB from doing a 1031 exchange. There's nothing that stops a QSB from doing 1202s. Historics definitely could be done, but I think it takes the right fact pattern and
Sure.
the right advisors, because then you're working with much the way that I'm an opportunity zone specialist. I'm not a historic. I get it and I understand it, but I think to make sure that you're dotting I's and crossing T's on both programs, you're going to need separate advisors or one person who knows both really well.
We had a question on how somebody might structure if the GP is close ended 5 to 7 year fund, not an OZ investor, LP is an OZ investor, thinking of GP being able to get out of the ownership of the property after year 7 without impacting OZ qualification of the LPs.
I think if the general partner in the QSB wants to sell their equity, I don't think that's going to terminate the OZ benefits. The fact that the QAF owner stays in and the fund is still owning the QSB, I see no issue with a GP selling. Now they've got to find someone who wants to buy their equity because they can't sell the property.
Sure.
I don't
Sure.
see that. If I understand the question correctly, and then certainly happy to entertain any follow-up calls, but I don't see that triggering an inclusion event of any kind.
Robert asked, can you provide more details on the 10 and 30% step up on the 5 year? I've seen this talked about a few times. Folks are a little unclear on this, so I think a little bit more clarification there could be helpful.
Sure. Any eligible gains that are rolled into a qualified opportunity fund beginning on 1/1/2027 are going to be deferred for 5 years from that date. So if you invest in June of 2027, your $1 million of capital gains you invested on that date are not going to be taxed with your 2027 1040. They are instead going to be taxed with your 2032 1040. The date that, I guess under my fact pattern of June, that would be part of your second quarter 2032 estimate, as opposed to OZ 1.0, which is going to be a Q4 2026 liability. But under that, if you hold your equity for 5 years, out of that $1 million, if you invest in a QROF, a qualified rural opportunity fund, you're only going to pay tax on $1,000. You invested in a non-QROF, just a normal QOF, a lot of acronyms, you're going to pay tax on $900,000 of capital gains in Q2 of 2032. It's a moving deadline, unlike under OZ 1.0, where you invested in January of 2018 or today or January of 2026. No matter what, all the capital gains are due 12/31/26. Now it's just deferred for a hard 5 years.
Sure. Well, and that permanence makes that an appropriate decision versus the hard date and then everything gets
That's right.
progressively just a little
They-
worse all the time.
The rolling decennial designations, because as part of the permanency of the program, of course, the process that we're going through here now, and then designating those zones in next July and then effective January of 2027, and do that same process every 10 years. They had to do something like that because they couldn't defer them to a hard date when it's a rolling program that's forever there. The initial program fundamentally was written to sunset 12/31/26.
Thank you again, Colin Walsh, for being here and just for your leadership really in the opportunity zone space. Great content today and a lot of great questions. Thank you to those of you who peppered some in for us. And we'd love to have you back sometime, talk about how it's all been going, maybe as all the train wrecks get sorted out down the road
Yeah.
here a little bit. But thank you again for being here today and for giving us all some time.
Thank you, Jeff.
All right. We'll talk to everyone soon. Thanks so much.